Hi, my name is Graham Hubertz doing the Session 9 assignment for Management 310. So our assignment today is to calculate the weighted average cost of capital, WACC, for Netflix in connection with the hypothetical $5 billion content investment decision. Your analysis must determine current WACC, evaluate the impact of additional debt financing, assess project-specific versus firm-wide discount rates, and compare Netflix's cost of capital to industry peers. So I'll read over the overview, I'll show you what I put into Gemini, and the code and summary that is spat out, and what our result is. So first we'll go over the overview. So Netflix financial parameters are hypothetical. Our market capitalization is $200 billion. Our total debt at the book value is $14 billion. Debt at the market value is $13 billion. Our equity beta is 1.3. Our bond rating is 3Bs plus or BBB plus, which our yield is 5.8%. Our corporate tax rate is 21%, and our current stock price is $450. So our market conditions, our risk-free rate on a 10-year treasury is 4.5%. Our market risk premium is 5.5%. Our media industry WACC range 8 to 10%. Our strategic context. So Disney's capital structure is 70% equity and 30% debt, which our WACC is 8.2% for Disney. Amazon Prime Video uses Amazon corporate WACC, which is 9.5%. Netflix is considering $3 billion additional debt issuance for content investment. So a required analysis. We are supposed to calculate Netflix's current WACC, determine the WACC after $3 billion debt issuance, evaluate project-specific WACC, U.S. content versus international content, and compare Netflix WACC to Disney and explain differences. And then we recommend optimal capital structure strategy. So we'll use the driver framework requirement for this, which is discover, represent, implement, validate, evolve, and reflect. So we'll go over into Google Gemini. I said to Gemini, I have an assignment due for class today, and I want you to use the KISS method, keep it simple and stupid when making the video while also following the driver framework. I also had it spit me out code, which I'll show later on. So as we'll scroll down, I put in the prompt that we just read over. Okay, so here we go. Here's our WACC calculation. So for the first two letters of driver, discover and represent, here's our current WACC calculation. The weighted average cost of capital is the minimum rate of return a company must earn on its existing asset base to satisfy its creditors and shareholders. The formula for WACC is WACC equals, in parentheses, E over V times RE, which is our cost of equity, and then in parentheses D over V times cost of debt times 1 minus corporate tax rate. E is our market value of equity, which is our market cap. D is market value of debt. V equals E plus D is total value of the firm. R with the little e is cost of debt equity. R with the little d is cost of debt. T with the little c is corporate tax rate. So we'll calculate the cost of equity. First is R with the little e. We use the capital asset pricing model, CAPM. And our equation here is R with the little e equals R with the little f plus beta times, and in parentheses, R with the little m minus R with the little f, which our risk-free rate, which is our R with our little f, is 4.5%, our equity beta is 1.3%, and our market risk premium, which is our R with our little m minus our R with our little f, which is 5.5%. So we plug those in, we have 4.5% plus 1.3 times 5.5, we get 11.65%. So now we calculate the cost of debt, which is R with the little d times 1 minus T with the little c. The after-tax cost of debt is used because interest payments are tax deductible. So we use our pre-tax yield, which is R with the little d, which is 5.8%. Our corporate tax rate, which is T with the little c, is 21%. So we plug those numbers in. We have 5 times 8% times, and in parentheses, 1 minus 0.21, which gives us 5.8% times 0.79, which gives us 4.58%. Now we go into calculate capital structure weights, which is E over V and D over V. E is equity, which is $200 billion. Debt is $13 billion for our D. Total value is $200 billion plus $13 billion, which equals $213 billion. So our weight of equity is 200 over 213, which is 93.9%. Our weight of debt is 13 over $213, which is 6.10%. So now we calculate our current WACC, or weighted average cost of capital. So now we put these in. We have 93.9% times 11.65% together, plus 6.1% times 4.58% together, which would give us 10.94% plus 0.28%, which gives us 11.22%. So current Netflix weighted average cost of capital is 11.22%. So now we implement. We use WACC with additional debt. Netflix is considering a $3 billion additional debt issuance for the content investment. This changes the capital structure, but is assumed not to change the cost of debt or cost of equity for simplicity, which is our KISS method assumption. So now we go into new capital structure weights. So new debt, which is D new, is $13 billion plus $3 billion, which gives us $16 billion. Our new total value, which is V new, is $200 billion plus $16 billion, which gives us $216 billion. Our new weight of equity, which is E over V new, which is our new total value, it's 200 over 216, which is 92.59%. Our new debt, new weighted debt, is D over V new, which is 16 over $216 billion, but same thing, be 7.41%. So now we calculate the new WACC. Our WACC new is 92.59% times 11.65% together, plus 7.41% times 4.58% together. So we have 10.78% plus 0.34%, which gives us 11.12%. So our weighted average cost after capital, weighted cost of capital, after $3 billion debt issuance is 11.12%. So our impact, the WACC decreases slightly from 11.22% to 11.12% because the firm is replacing expensive equity financing with cheaper tax advantage debt. So now we go into validate. Project specific versus firm-wide WACC. A firm's WACC is the average hurdle rate. However, a single firm-wide WACC is often an inappropriate discount rate for all projects. So, our project type, U.S. content, firm-wide WACC, which is 11.22%. Our rationale here is this is Netflix's core business / market, and the project risk likely aligns closely with the company's average risk profile, which is our beta. International content, our project-specific WACC, which gives us a higher percentage. Our rationale here is that the international expansion, especially into emerging markets, is generally riskier than the U.S. core business. The project's cost to equity should be higher. Use a higher beta to reflect the country, currency, and political risk. A firm-wide WACC would understate the true cost of capital for a riskier venture. So now E and R, evolve and reflect. Industry comparison and strategy. So we compare this to peers. Netflix's current is their weighted average cost of capital is 11.22%. So our capital structure is 93.9% over 6.1%. This gives the key difference here is that we have a high WACC, especially extremely low debt usage, resulting in a very high reliance on expensive equity financing. Disney's WACC is 8.2% with a capital structure of 70% over 30%. This is our lowest WACC. They have a significantly higher debt usage, lowering the overall cost of capital. Disney is a more mature business with stable, predictive cash flows, allowing for more debt. Amazon Prime Video's WACC is 9.5%, and we just have a corporate WACC here for our capital structure. The difference here is that it uses the WACC of its parent, Amazon, which has a more diversified, lower risk profile than a pure play streamer like Netflix. In our media industry range, 8% to 10%. There is no capital structure here. Netflix's WACC is above the industry range, indicating its capital structure is suboptimal. So, our optimal capital structure recommendation. Our recommendation is that Netflix should continue to increase its debt usage to move its capital structure toward the industry average, which is closer to Disney's 70-30 fraction. Our rationale: the debt is currently the cheapest source of financing, 4.58% after tax, compared to equity, 11.65%. Increasing debt lowers the WACC, maximizing the firm's value. It provides tax shielding benefits as their interest is tax deductible, and it signals confidence in financial maturity to the market. So in conclusion, the $5 billion content investment is a good catalyst to increase debt financing. While the initial $3 billion debt issuance marginally lowers WACC to 11.12%, Netflix should continue to issue debt until its financial risk profile, its credit rating, begins to deteriorate, which will provide the greatest benefit to shareholder value. So I had to import this into Python code and into Collab, as here is our Python code. This goes over what we just talked about. As our Python code goes over every single frame of driver framework as discover and represent, our implement stage here, our validate and reflect stage, and that's it that I have. And as we said, our conclusion here is that our $5 billion content investment is a good catalyst to increase debt financing. That's it I have for today. That's my session 9 assignment for Management 310. Thank you.